Hi friends, my name is Rahul Jain. I'm a SEBI registered research analyst. You would have heard that FIIs have been selling heavily in Indian stock market. And in fact, the data is that in Q4 FY26, record selling of around 1.3 lakh crore has happened. However, they also bought stakes in around 120 Indian stocks in the same period. Meaning what? That out of more than 6,000 companies that are listed on Indian exchange, they have shown interest in 120 Indian stocks. Now it's impossible for us to go through each of these. So what I've done is in this video, I'm going to walk you through three stocks. Okay. One is from large cap, second is from mid cap, and three from small cap, so that we cover the entire spectrum. But more importantly, I'm going to share very interesting insights about these three companies. These three companies are not buy or sell recommendations. I'll actually practically teach you some important investing principles and also give you insights about these three companies. If you're new to my channel, request you to watch this video with open mind. And also, before I start this video, humble request that please do not write the names of these three stocks in the comment box. You're not going to save anybody's time. If somebody really wants to learn these insights, let them watch the video. With that, let's get this video cracking. Stock number one is NTPC Limited in the power segment, and you might say that Rahul, this is a very boring stock. Why are you even talking about it? There are very interesting development happening in this particular company. That's why I'm talking about it. But before that, first let's have a look at FI stakes. It has gone slightly up from 16.24% to 16.54% in the March 2026. But more importantly, if I give you the valuations of this particular company, let's have a look at PE ratio of this company last 10 years. Median has been 11.9, but right now it is trading at around 16 or 15.8. Okay, and I don't know when you're watching this video, this data may change. Okay, now interestingly, what you note is that up until this point in time, okay, which is around November 2023, the stock always remained very low in terms of the PE ratio, but all of a sudden it went and crossed, almost, let's say here 18 or 19, went up to almost here, if you see, the highest was at around 19.8. This particular valuation that you see, in my view, was a stretched valuation because we were in a massive bull run at the time. Then this valuation got corrected, okay, and now this is trading at around 15.9 PE, okay. Very similar case with price to book as well, right? This period here that you see, massive stretch in the valuations. We were in a bull run, then correction happened, and then right now it is trading at a price to book of 2. Mind you, if you compare this with peers, it is still at a very cheap valuation. NTPC trades at around 16 PE at the minute, and if you see Adani Green, which are private companies, JSW Energy, etc., huge P's, very high P's. Okay, if you look at the price to book, NTPC is quite cheap as compared to many other companies, right? Now you may say that, Rahul, it is likely to happen because this is a Sarkari company, right? And it comes with all of the risk that government controls it and things like that, right? Absolutely agree with that. Now comes the question, how is this company doing fundamentally, and why do I think that FIs are taking interest in this particular company? Okay, so first let me walk you through the fundamentals. There is nothing exciting, to be honest, as of now. For example, if you look at 9 months of FY26, last quarter results have not yet come out when I'm recording this video, but if you look at the growth rate in terms of the power generation, see, it is down as compared to FY25. So nothing exciting happening here. If you look at the fundamentals in terms of the top line or the bottom line, again, if you see, not huge growth. FY25 9 months versus 9 months FY26, if you see 13871 versus 14415 crores, not a growth company at all. And if you look at the PAT as well, very flat PAT. Okay, 16,931 crores versus 16,056 crores. So as of now, if you look at the fundamentals, one would argue that, why FIs will take interest in that? And this is where, when I was looking at the recent development about this company, one of the major things that I found is the nuclear energy foray that NTPC is getting into. I don't know how many of you know, but it was published that Indian government by 2047 wants to get to 100 gigawatts of nuclear capacity, meaning energy coming from nuclear sources. Okay, now out of that 100 gigawattage, 30 gigawattage is going to come from NTPC. Okay, now this is a long-term game here. Okay, and in order for NTPC to fulfill that 30 gigawattage of nuclear capacity, what they have done is they have come up with a JV, first of all. Okay, this JV is between NTPC and Nuclear Power Corporation of India Limited. The name of the JV is Anushakti Vidyut Nigam Limited. Also, they have formed a wholly owned nuclear subsidiary called NTPC Parmanu Urja Nigam Limited. So something is happening there, and they are going to establish 4 nuclear power projects in Rajasthan. Okay, they will be each of 700 mega wattage. So this is a very futuristic looking development, and if you feel that nuclear energy is the way to go in the next 20 years, then NTPC is likely to hold a monopoly state in that particular segment. And as of now, if you see their energy sources, so for example, coal is around 69% of their energy generation. Imagine 2047. I think this coal might come down to, let's say, 30 or 40, right? And nuclear energy might take, I don't know, 30%, 40% sort of a cut in this overall pie, right? This is where NTPC is heading towards. And as of now, if you look at the valuations as compared to the peers, you will find that it is the cheapest. So if you want to play the power theme, then NTPC definitely is an option for you that you go and learn about it. It's not a short-term thing. It's going to be a long-term view about the nuclear energy. If you are bullish about that, then definitely go and explore NTPC, right? NTPC might take the monopolistic situation when it comes to nuclear power generation. And this is, I'm talking about 10 years down the line, 15 years down the line, right? This is the main thing that you need to understand about this company, right? So this is large cap company. I've talked about it. Let me now move to a mid cap company. And this mid cap company, there is something big happening that you need to understand. But so far, if you're liking this video, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to do this kind of content for you at zero cost. With that, let's move to stock number 2. The second company that I want to speak about is Vishal Mega Mart. Okay, what you see on my screen is FI stakes have gone up from 15.52% to almost 22%, and DIs also have been buying this company from 25% to 32%. Promoters have sold. I'll come to that in a minute. Very interesting insight that you need to know about promoters. Okay, but before that, if I talk about the PE ratio of this company, you will see huge decompression in PE ratio. Okay, back in July 2025, it was PE of 140, almost 140. It's now come down to almost 73 level. Okay, in the March month, it actually dropped to 60. Now it is at around 73. Okay, so huge compression has happened in the PE ratio. Now, if I talk about the growth rate of the company, if I show you the growth rate, see, if you look at the trailing 12-month sales growth, 21%, very good growth rate in terms of top line. If you look at the profit growth rate as well, trailing 12 month 36%. Even if you look at 5 years, 3 years, huge growth you will see in the numbers. So fundamentally the company is growing, earnings is growing. That's why maybe it is trading at a very high P. Okay, 70-80 P right now. Okay, now coming to companies other fundamental aspect. For example, if you look at the SSSG, which is the same store sales growth, around 10%. For a retail company, if their same store sales growth is at 10%, it is considered healthy in my view. Top line has grown at 19.9%. Gross profits have grown at around 20.1%. Adjusted EBITDA 26.7% growth rate. Adjusted PAT and margin 27.9%. Overall, if you see, the fundamentals are very good even in the last 9 months or so. There is no problem there. Okay. If I also talk about the dependency on one particular region. So for example, if you look at East, North, South, West, quite diversified. It's a pan-India sort of a retailer that you can see here. Okay, very good diversification already. So that risk is also not there. If I talk about the tier 1, tier 2, tier 3 cities, very good diversification here. So fundamentally, if you see, it's gonna tick almost all your boxes that you can think of. Of course, there will be some, negative red flags here and there. But now let me talk about what is actually happening with the promoter sales. Okay, so very interesting story that you need to know. Okay, so if I take you back to 2011, okay, so the company was founded by a guy called Ramchandra Agrawal. Okay, in 2011, he sold the entire stake to a company called Shriram Group and TPG Capital. Why did he sell? Because of 2008 crisis, there was huge debt on the company. So he sold it to Shriram Group and TPG Capital. Okay. Now what Shriram Group and TPG Capital did was that they bought this guy called Gunendra Kapoor. Mr. Gunendra Kapoor, he is still the MD and CEO of the company as far as I know. Okay. So he's been there from 2011. And this is a very important point that you need to understand. Okay. Now what happened is that he turned around this company. Okay, from 2011, he started turning around this company. It was in huge debt. The company started to make some good traction in terms of the profit, etc. Okay, now coming to 2018, what happened was that TPG Capital and Shriram Group, they sold their ownership to a company called Kedara Capital Fund LLP. Okay, this is a PE firm, but interestingly, this is owned by Samayat LLP. Again, this is just a holding structure. Don't worry about it. Point is that in 2018, TPG Capital and Shriram Group, they also sold it to Kedara Investment. Okay. So Kedara Investment had around 96% equity at that time in 2018. Okay. Now, interesting things started to happen that they did their IPO in December 2024. Okay. The issue price was 78 per share. Okay. the stock got listed with a premium of 33% at 104. So first of all, they got IPO timing very, very right. December 2024, we were in a very, very good market condition. 33% premium is what they got. Now, if you look at this IPO, this was completely offer for sale. Okay, it means these guys, promoters, they had around 96.55% stakes. They diluted around 23%. If you read the numbers here, around 23% dilution they did, came to around 74-75%, whatever that number comes. Okay, so they exited at 78 rupees per share price at that time. Huge dilution in their equity at that time. Okay, now what happened after that is, after a few months, 6 months to be precise, June 2025, the promoters again sold how much? Around 19%. Okay. So this was another big drop in the promoter stake that you will see in the screener. Okay. Then they did not stop here as well. Again, they sold around 14% of their stake, bringing their total stakes to around 40%. What is happening here is that the slowly promoters are exiting it. Okay. FIs are buying it. DIs are buying it. So there is a ownership change that is happening within the company from a stakes perspective. Now, is this a good thing or bad thing? See, typically when promoters are reducing their stakes, generally it is considered very, very bad, red flag. But PE companies, they need an exit. Okay, they have been owning this company since 2018. So they got the IPO exit at 2024. Okay, after that they have been continuously selling. Now, why are they selling? That is more important part. So here is the thing that you need to know, that Mr. Gunendra Kapoor, okay, he is at around 64 years of age. Okay, now it might be 65, 66, I don't know exactly, but he is sort of coming to the retirement age. And in fact, he had stepped down from CEO role before IPO, but then he was brought back again into the company because they wanted the IPO to sail through. Are you trying to understand what I'm trying to tell you? That PE company is exiting, the promoters are exiting this, and they are keeping Mr. Gunendra Kapoor until they completely exit it, or they reduce the stake to, let's say, 10%, 20% or whatever. So there is likely to be continuous selling by promoters. That's what my thesis is in this particular company. It's not necessarily a bad thing. Ultimately, they would want an exit, but FIs and DIs are buying this company. Why? Primarily, fundamentals are strong. But please ask one thing here. Mr. Gunendra Kumar, if he leaves the company, okay, then will the new guy be able to run the company as efficiently that as Mr. Gunendra Kapoor was? This is the risk that you need to understand. I know I've taken 5 minutes to explain you this story, but this is where the exact risk lies in the companies whenever you're picking the stocks. Okay, it's not just about looking in the fundamentals. You're seeing the profit growth is there, ROE is looking very, very good. Okay, company is growing PAT at like 20%, 25%, right? Stock is beaten down, PE has compressed, valuations are looking much better than, I don't know, 8 months back. But please understand why promoters are exiting. Okay, PE firm is exiting because they want an exit. But one of the reasons could be that the Gunendra Kumar, Mr. Gunendra Kumar, he is the key guy who actually turned around the company from 2011 onwards. And if he steps out, I don't know, in the next 6 months, 12 months, 2 years, that is a bigger risk. And that is what you need to bake into your investing decision. That's all I'm saying. I'm not saying whether it's a bad company or good company. Fundamentally, it's looking very, very good company. It is entirely possible that the new guy who takes over might do good. Who knows about it? But this is a precise risk that the moment Gunendra Kapoor leaves the company, you might see short-term pressures. And in fact, you need to really rely on the new guy to continue to do the good work that the company is doing. I hope this entire analysis makes sense. And if you like this, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to do deep dive research for you about these companies. Also, you can consider joining my YouTube community. Almost on a daily basis, I'm trying to post giving you these insights. It's not a buy sell recommendation sort of a community, but you learn a lot in that community from each other. And I post very, very good insights that helps you make good investor. Okay. Feedback of the community has been good. Simply go to my channel, press the join button and be my guest. With that, let's move to stock number 3 now. The third company is Home First Finance Company India Limited. Okay. What you note very quickly, similar pattern, what we saw in Vishal Mega Mart. Promoters have been exiting 6.98% only. And if you look at the FIs have been buying 40.82% to 45.72%. Okay. Here is an interesting thing about this particular company's valuation. So if I go to valuations and show you price to book ratio, and if you look at last 10 years, okay, the median has been around 4.1 and right now it is at around 3. It's dropped below median PB. Okay. Now, if you look at the company's top line growth or profit growth, healthy numbers is what the company has presented. You can see trading 12 month 37% PAT growth rate, sales growth if you see 28%. So from top line and bottom line perspective, good growth rate is what you will see. But here is an ultimate comparison for few important parameters that I've done among few companies: Home First Finance, Aptus, Aadhar, and PNB Housing. Okay. Now, few important insights that I want to make. PNB Housing by far is the largest in terms of the asset under management, around 87,000 crores. By the way, these data points might be slightly here and there. It's not exact numbers, but it gives you good relative comparison. Okay. So 87,000 crores of AUM. So PNB Housing is the biggest of the lot. Okay. While Aadhar is at number 2 in terms of the size, and Home First and Aptus is at number 3. Okay. Now, what you note is that from a valuations perspective, out of these 4, cheapest is PNB Housing. Okay, 1.3 PB ratio. Okay, that is the cheapest as compared to Aptus, Home First, Aadhar. They are more than 3. Okay, as we saw. So if you're a value investor, you will go and explore PNB Housing. Okay, but if you look at the growth rate, top line growth rate and PAT growth rate, then PNB Housing is the lowest among the lot. One reason could be that their base is very high, 87,000 crores of AUM. So it is very difficult to grow a higher base. Okay. But from a valuation perspective, definitely PNB Housing is the cheapest. And the growth rate perspective, this is the lowest in terms of the growth rate. Okay. Now, if you look at the asset quality, that is what is very, very important whenever you're looking at any NBFCs or banks, right? If you look at the gross NPAs here, you will find that PNB Housing is the best, or the Aptus, 1.1 to 1.2% versus 1 to 1.2%. That's the range sort of you get from PNB Housing. So definitely from an asset quality perspective, PNB Housing is much better, or Aptus is much better as compared to Home First Finance and Aadhar Finance. Okay. From a NIMS perspective, if you see, best is Aptus, 12 to 13% versus 7 to 8% by Aadhar, and Home First is 5 to 5.2%, and PNB Housing is the lowest. Okay. So overall, if you see from a growth perspective, Aptus and Home First Finance is giving you possibly the best growth rate. I'm talking about the PAT growth rate here, 25 to 26%. Okay. And if you look at from an asset quality perspective, Aptus and PNB Housing much better. And from a PB perspective, valuation perspective, although PNB Housing is cheapest, but if you see, the number 2 will be Aptus. So here is what you need to choose out of. Do you want to go for value or growth? If you want to go for value, then explore PNB Housing. Look at what the management is saying about PNB Housing. If you want to focus on the growth, then your choices are between Home First and Aptus. Again, you will have to read a little bit more about the management commentary and some other factors. But overall, as of now, valuation wise, Aptus is slightly better than Home First Finance. And from a PAT and top line growth perspective, very, very similar range is what you will get. Asset quality, Aptus is better. This is how you need to go and do some pair comparison, which is more relevant to that particular segment. We are talking about housing loan segment here. So there is no point in comparing ROE, for example. I mean, you can do that, but definitely look at, for example, ROA, return on assets. This is how you need to go about comparing it. Don't just blindly buy a company because FIs are buying it or DIs are buying it, because there is a red flag here as well, because in Home First Finance, promoters have been continuously exiting the company. You will find the similar case with Aptus as well. These are all PE companies that are taking exit, and FIs and DIs are sort of taking the lion ownership. So these are the 3 companies that I want to give you some insights about. Again, not buy or sell recommendation, but hope you learned something new. And if you did learn something new, let me know in the comments. It makes me really happy to see a lot of people are commenting. They are learning something new every single day. And if you feel that you are learning something new, hit the subscribe button, like this video, share it with your friends and family. I'm going to see you in my next video. Until then, keep rocking.